Welcome back to another explainer. Today we're tackling something that literally affects every single one of us every single day, and yet it's so often buried in this dense, unapproachable financial jargon. We're talking about the economy. Specifically, we're going to trace a direct line right from the prices you see in your everyday grocery cart all the way up to the massive multi-trillion-dollar bond market. By the end of this explainer, you're going to have a crystal clear understanding of how inflation actually works, why the Federal Reserve does what it does, and exactly how all of that impacts your wallet and your investments. All right, here's our roadmap for today. 1. Measuring the cost of living. 2. Demand pull versus cost push. 3. The Fed hits the brakes. And 4. The bond market seesaw. Let's get right into it. Section 1. Measuring the cost of living. Now, we hear the word inflation thrown around constantly on the news, right? But at its core, inflation is just a sustained increase in the general prices of goods and services, which naturally leads to a decline in your purchasing power. If we strip away all that textbook economic speak, it simply means that a single unit of your money, like a $1 bill, buys you less today than it did yesterday. The money in your pocket is literally losing its muscle over time. So how do we figure out how fast that purchasing power is actually dropping? Well, the government uses something called the Consumer Price Index, or the CPI. I want you to imagine a giant, everyday shopping cart. The government essentially pushes this cart down the aisles of the economy, and they fill it with a market basket of things that everyday households actually buy. We're talking groceries, housing, gasoline, medical care, the whole shebang. Then they take that exact same cart to the register, month after month, year after year, and track exactly how the total receipt changes. That change, that is what gives us our official inflation rate. Let's ground this concept in reality for a second. Think about an apple in that giant government grocery cart. Our sources use a great simple example here. If an apple cost $1.50 last year, and this year that exact same apple costs $2, well, that's a 33% price jump. You haven't gained any extra apple, the quality of the apple hasn't improved one bit, but it takes 33% more of your hard-earned money to acquire it. That is a direct, practical hit to your purchasing power, right there in the produce aisle. Okay, moving to section 2, demand pull versus cost push. Economists generally divide inflation into two main camps, demand pull and cost push. Let's break these down. Demand pull inflation happens when there's more demand in the economy than there is supply. Imagine you're trying to buy tickets to a totally sold-out concert. Thousands of fans desperately want to go, but there are only a handful of tickets left. What happens? The price skyrockets, because that massive demand is physically pulling the price up. On the flip side, cost-push inflation is an entirely different beast. Picture a local bakery. They aren't suddenly getting swamped with a million new customers. Instead, say, a supply chain issue causes the wholesale price of eggs and flour to suddenly double. The bakery has to raise the price of their cakes just to survive. They're pushing the increased cost of their inputs directly onto you, the consumer. So it's two completely different causes, but it's the exact same painful result at the register. Which brings us to section 3, the Fed hits the brakes. If you watch the news at all, you know the Fed's primary weapon against inflation is adjusting interest rates. But why? We really need to pause and ask this absolutely critical question. How does raising interest rates actually help control inflation? It's a fantastic question because, honestly, making things more expensive to buy seems kind of counterintuitive when prices are already too high, doesn't it? Let's trace the logic. Okay, so it all starts when the Fed raises their target interest rate. Step 2, instantly, borrowing costs rise across the board. Mortgages get more expensive, auto loans go up, business loans cost more. Step 3, because borrowing is suddenly so incredibly pricey, everyday people and businesses hit pause. They delay buying that new house or expanding that factory. Economic growth and spending start to slow down. Think of it like throwing a giant bucket of freezing cold water on a red-hot housing market. Finally, step 4, with everyone spending less, overall demand drops. And remember our concert ticket analogy? When demand drops, prices stop skyrocketing. Inflation levels off, the Fed has successfully cooled the engine by purposefully making money harder to get. And that leaves us right into section 4, the bond market seesaw. There is a fundamental, totally unbreakable rule in the bond market. Bonds and interest rates exist on a permanent seesaw. When interest rates, which, as we know, are driven by the Fed, go up, the prices of existing bonds go down, and vice versa. But why is that? Why does a totally unrelated decision in Washington make your personal bond investment drop in value? Well, let's look at an example. Consider an investor named Jane. Say Jane bought a 10-year bond a few years ago that pays her a fixed 4% interest rate. It was a great deal at the time. But then inflation hit. and the Fed raised interest rates to cool the economy. Now, companies issuing brand new bonds today have to offer a competitive 6% interest rate just to attract buyers. Think of this exactly like smartphones. Jane's 4% bond? That is last year's smartphone. I mean, it works perfectly fine, but a shiny new model just came out that offers way more power, 6%, for the exact same initial price. If Jane wants to sell her old 4% bond today, no one in their right mind is going to pay full price for it when they can just go buy the shiny new 6% bond. So Jane is forced to drop the price of her existing bond to make it attractive. That is exactly why rising interest rates crush existing bond prices. The price yield seesaw is a hard and fast rule. They always move in opposite directions. Rising rates drop existing prices, and falling rates raise existing prices. And crucially, our sources note that longer-term bonds, like a 10 or 30-year bond, actually see the greatest price changes. Why? Because you are locked into that older smartphone for much longer, so the penalty is a lot steeper when better models come out. So the chain reaction is clear. Inflation triggers the Fed raises rates, and those rate hikes directly depress the value of the bonds sitting right there in your portfolio. We have officially followed the entire chain, from that 33% jump in the price of an everyday apple to the Fed aggressively pulling the emergency brake by raising borrowing costs, right down to Jane losing value on her 4% bond. It is a massive, incredibly delicate balancing act, which leaves us with this final, really provocative thought. If the Fed's cure for inflation intentionally risks crushing investment prices and purposefully slows down economic growth, is the medicine actually worse than the disease? There are absolutely no easy answers in economics, just trade-offs. I hope this explainer helped you understand those trade-offs just a little bit better. Keep learning, keep asking questions, and I'll catch you on the next explainer.